Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Ken Esch, partner and Trendsetter Barometer leader at professional services firm PwC, about the firm's most recent survey of U.S. private company executives.
So, an interesting report again. You know, it's just I guess starting at the sort of the top line, the top headline is, I don't know how you felt about it, but when in reading the responses and the numbers, there just seemed to be kind of a meh. That's a technical economic term, I believe. But the optimism levels seem to be pretty flat. Maybe sinking a little bit, but just sort of,
Yeah, they kind of stabilized after a pretty big fall over a year ago, and I think that there's so many negative stories going on out there, mostly globally, that have a tendency to affect optimism here in the U.S. as well, just because the economies are so interconnected that it's hard to find a company that just doesn't have some exposure to the international markets. So I think that they feel the uncertainty going on in Europe, somewhat in China with things slowing down there, and they've dialed back expectations. No doubt about it. And I think the good news within the report is that so many companies still expect to grow, and so few of them expect to see revenue fall. So I think that there is concern about the economy, but they do still feel like they're going to be growing over the next 12 months, which is important.
Yeah.
Just probably not at the rate that they'd like to grow.
Yeah. No, fair enough. I mean, and do you attribute that, or do the responses attribute that? I mean, you had sort of mentioned the global uncertainty, obviously Brexit, and even Europe's just general lack of growth. You read the headline numbers from the EU and now the UK, specifically. And the UK is sort of gloating about a 0.6% growth rate, which in the U.S. would be sort of, the pitchforks would be out and and the sack and ashcloth crowd would be ready to go. I mean, it and obviously China is still seems to be in the muck. Is it largely that part, or is there anything sort of domestically that jumped out in terms of this, anecdotally or otherwise?
Well, I think on the domestic front, probably two things that contribute to it. One is the election cycle that we're in, and I think that many of the voters are kind of struggling, with the choices and candidates that are left.
You don't say.
And the proposals that they're putting forth, and just not having a good feeling or much certainty about A, who's going to win, and B, whoever wins, what kind of proposals might make its way into legislation and be passed. So, I think that there's some uncertainty caused by the election, and that's not uncommon. As you know, our history goes back 20 years, on these reports, and we've seen this in past election cycles, where we've seen some drop in optimism, leading up, to an election. This one's no different than others out there. So I think that is a contributing factor. And then the other is that while the stock market seems to be going up, I think a lot of people out there are still laboring under tough conditions without much in the way of increased wages and not much in the way of new job prospects. So they feel like while they may not have a risk of losing their job, in the near term, that they really don't see, much in the way of increases in their wages or maybe their buying power, and therefore they're not as willing to spend to kind of prop up the economy.
Yeah, that's an interesting point, because the headlines were, almost joyous over the jobs report on Friday. And I guess, it's good that we're producing over 200,000, a quarter.
Mm-hmm.
That's good. It's not great, but it's good. And people are talking about full employment, and wages are beginning to tick up a little bit, average wages. But there does seem to be that there's something missing, and I don't.
Yeah.
You know what I mean? I mean, there's good news, but we're not really seeing much impact. I mean, from the middle market perspective, and I saw that the planned wage increases are pretty much the same, and there doesn't look like to be a real appetite for increasing headcount. So, it's hard to sort of square all those circles,
Yeah, I mean, I think, with the jobs reports, it's great that we had a couple months, worth of, jobs, increase above 200,000. That's a positive, a positive note. But, if you look at the averages, over, a longer period of time, we're still creating fewer jobs, this year than we did last year. And with the population growth, you need to create more than 200,000 jobs a month just to kind of keep up with the increases in the population. And as we've talked before, the unemployment rate, is a metric that many people, look at, but I'm not sure how relevant it is in today's, economy, because post-recession we've got so many people sitting on the bench. And if you look at like labor participation rate, those are closer to historical lows, in the low 60, percentiles. And that means that there are a lot of people who are either available to work but can't find it, or perhaps maybe working but not working as many hours as they would like, or in the type of job that they would like to have. So I don't gain a lot of comfort, from looking at a unemployment rate below 5%, when our labor participation rate is so low.
Yeah, no, I agree. I mean, it's a pretty crude measure when you get right down to it. The unemployment rate, in particular, is a pretty crude measure.
Yeah. Our report here that fewer companies are expecting to hire over the next 12 months, and that the headcount increases are stubbornly lower than 2% a year, which has been consistent, for most of the post-recessionary period, and then wage increases are below 3%. That just doesn't paint a really, pretty picture, with respect to hiring over the next 12 months, or the impact the economy might get from more people working, or more people working at higher wages.
I don't know, and this isn't really part of the report, but I'd be interested to hear your insight on it, and given your contacts with your clients. I still contend that this sort of temporary insanity about establishing a national minimum wage, which and the combination of that, and which I recognize doesn't really hit like manufacturers and things like that, but it does hit a lot of union. There are a lot of union wages are tied to those kind of things, which can increase things. The combination of that and the advent of robotics, which has been with us for a while, but it's becoming, much more aggressive and much more cost-effective. As wages, at least on the low end, go up. I don't see a lot of brightness there.
I'll give you two quick, examples of how that minimum wage, issue, and I'll call it, productivity, go into the equation when trying to decide to hire. I talked to a group that operates independent grocery stores. And, the minimum wage is like their hot button legislative issue right now, which kind of surprised me, because I kind of asked the question, like, well, how many people do you have, working for minimum wage in a grocery store? And it's not, a huge percentage of the overall working population, but it's the floor, from which everything else is set. So
exactly.
if you take that minimum wage and you go from let's say $8 an hour to $12 an hour, that group at the very bottom of the ladder is going to inch upward. But the impact it has on the overall workforce there is that everybody else has to go up too.
Right.
And that becomes a much larger impact. And they would tell you clearly, they would make decisions on how many people they can hire for the dollars that they have allocable to wages, because they just don't have the pricing power, to push it through to their customer base, right? So
yeah, particularly in that business, yeah.
Yeah, they would tell you, hey, we operate at a slim margin already. We are constantly battling our competitors, for revenue, and we don't have, the margin, just to accept, a wage increase for all of our people. So, something's got to go. And then the other one was, to your point with respect to technology. It's in a manufacturing distribution type of business, but within their finance function, they've got quite a few people who are running reports, right? Which is all very, very interesting, but it's rather slow and may not be really capturing the information necessary to run the business. So they're making a significant investment in a business analytics tool. And one of the byproducts of that tool, is going to be that these individuals who are currently just running reports are going to need to be doing some different types of things, thinking perhaps more, analyzing more, as opposed to just producing a report. And they're going to find out, I think, pretty quickly that some of those workers are unable or unwilling to spend the time and effort, to do the analysis, but we're pretty comfortable just writing a report. Well, now the tool is going to be able to, gather the information and kind of write the report quicker than those individuals were going to be able to do it. So if you can't pick up the analytical side, you're going to be out of a job.
Yeah.
So they're making an investment here in technology, that is likely to reduce the need for headcount within that department. But at the end of the day, it's going to help the business make better, quicker decisions. And that's going to be a positive for the company, but it's going to be bad news for some of the individuals who are unable or unwilling, to make the transition to more of an analytical, type of role as opposed to just producing a report.
Yeah, we're going to see an awful lot of that. I mean, you're already seeing it. I mean, you just think of and particularly you think in low margin industries. I mean, like grocery stores. I mean, grocery stores now, half of their checkout lines are self-serve, right? That's happening in the fast food industry, which also has very, very low margins. Anything that can be automated is going to be automated. I've
seen it in some distribution businesses. Where they've decided to kind of rationalize their sales force and allocate people to higher volume, higher profitability accounts. And for the smaller accounts, they may not have an assigned representative. They may do their order input online, and rather than see somebody once a week, they may get somebody every 2 weeks or every month. So they're moving away from a sales rep, environment assigned to each customer, and segmenting the customer based on, what they need and how much attention, is required, to serve them.
Yeah, that's interesting. You mentioned, going back to the technological investment you just referred to, I noticed in the report that, a whopping 77% of middle market company or private companies are planning to increase operational spending, and which is obviously up a pretty good chunk from last year. Do you have any sense of what that spending is on? I mean, what's the sort of general sense of where that money's going?
IT leads the way, in that area, and that is often, defined by computing, software used to help run the business, and or power interaction between the company and the customer base. So things like business analytics, things like customer-facing applications are supplanting some people that were at the company, but it's all designed to make better, quicker decisions and also serve customers in a more profitable way. But it's also designed to interface with customers in a way that they feel comfortable. And as more and more of us become accustomed to mobile applications and kind of a do-it-yourself environment, businesses are adapting to that and providing that type of avenue into to the company for order entry, customer service types of interaction. So IT is kind of leading the way in that spending.
Right. Yeah, and I guess that is probably somewhat related to the concern about tighter margins. I mean, obviously with wages not really going up much, what's the sense on what's on the pressure on margins from the respondents?
I think it's general cost of doing business. Some of it, regulatory, types of pressures. Some of it is cost base that is not, in the form of wages, and a common one or example is healthcare. That companies are seeing that healthcare spend increase at a much higher rate than inflation. It's better than it would have been. I think is the response, but I'm not sure anybody knows what it would have been. So that I think that's a number that kind of creeps its way into the margin line, and I think that. Even going to some of the restaurants, it seems like my salad's a little bit more expensive, and a lot of the input costs are just like increasing, a bit. So, and that's just not necessarily captured, within some of the questions that we're asking. But it's not oil and it's not wages.
That's for sure.
Right now, it's other types of inputs.
Yeah. Okay. Well, I'm going to hold to my rule here. The half-hour rule. So I mean, overall, given all the various factors, I mean, how would you sum up this quarter's report?
I would sum it up as a bit of a mixed bag, but happy to see that we've are continuing to expect growth, over the next 12 months, and that while things could be better. With respect to hiring, companies seem to have stabilized, a little bit, and that over the next 12 months, I would expect, moderate growth, and we'll just keep our fingers crossed through the election.
Please check back for future episodes of the President and CEO Focus on the Middle Market podcast series. Thanks for listening.